Have you ever wondered how you can invest in private companies that are not listed on the stock market? Or how you can lend money to businesses that are struggling or growing fast? Or how you can earn higher returns than bonds or stocks with less risk? If you answered yes to any of these questions, then you might be interested in private credit, one of the hottest investments on Wall Street. Private credit is a broad term that refers to lending to private companies or individuals that are not publicly traded or rated by credit agencies. Unlike public debt, private debt is not standardized or regulated, and it often involves more complex and customized terms and conditions. Some examples of private credit include distressed debt, which is lending to companies that are in financial trouble, small business loans, which are lending to entrepreneurs and startups, and senior secured loans, which are lending to companies that have assets or cash flows as collateral. Private credit is not a new phenomenon, but it has grown rapidly in recent years. According to a report by Prekin, a data provider, the private credit market had over $1 trillion in assets under management as of June 2023, up from $600 billion in 2019. The annual growth rate of the market was 10%, outpacing other alternative asset classes such as private equity, hedge funds, and real estate. The report also estimated that there were over 600 private credit fund managers globally, offering a wide range of strategies and products to investors. But why has private credit become so popular among investors? And what are the opportunities and risks involved in this asset class? In this video, we will explore these questions and more, and help you understand the basics of private credit investing. Stay tuned. Reasons for the popularity of private credit. There are several factors that have driven the demand and supply of private credit in recent years, making it one of the most sought-after investments on Wall Street. Let's take a look at some of them. Low interest rates and high valuations in public markets. Since the global financial crisis of 2008, central banks around the world have kept interest rates at historically low levels, making traditional fixed income investments less attractive for investors who are looking for higher returns. At the same time, public equity markets have reached record highs, making stocks more expensive and risky. These conditions have created a search for yield and alternative sources of income among investors, who have turned to private credit as a way to enhance their returns and diversify their portfolios. Regulatory changes and capital constraints for banks. Another factor that has boosted the supply and demand of private credit is the regulatory changes that have affected banks after the financial crisis. Banks have faced stricter capital requirements, higher compliance costs, and more scrutiny from regulators, making them less willing and able to lend to certain segments of the market, especially small and medium-sized enterprises, SMEs, and distressed companies. This has created a funding gap that private credit providers have stepped in to fill, offering more flexible and customized solutions to borrowers who are underserved or overlooked by banks. Increased need for financing among middle market and niche businesses. A third factor that has fueled the growth of private credit is the increased need for financing among middle market and niche businesses, which are often the engines of innovation and growth in the economy. These businesses face challenges, such as limited access to public markets, high competition, rapid changes in technology, and complex transactions. They need capital to fund their expansion, acquisitions, refinancing, or restructuring, but they may not qualify for bank loans or may not want to dilute their ownership by issuing equity. Private credit providers can offer them tailored solutions that meet their specific needs and objectives, such as growth capital, bridge loans, mezzanine debt, or unitranche loans. Higher yield and diversification potential for investors. A fourth factor that has attracted investors to private credit is the higher yield and diversification potential that it offers. Private credit typically pays higher interest rates than public debt, reflecting the higher risk and lower liquidity of the underlying assets. Private credit also has lower correlation and volatility than public equities, meaning that it does not move in tandem with the stock market and tends to be more stable over time. These characteristics make private credit an appealing asset class for investors who want to generate income, reduce risk, and improve their risk-adjusted returns. Greater access and transparency for individual investors. A fifth factor that has contributed to the popularity of private credit is the greater access and transparency that it provides to individual investors. In the past, Private credit was mostly accessible to institutional investors such as pension funds, endowments, foundations, or insurance companies, who had the resources and expertise to invest in this asset class. However, in recent years, there have been more options and platforms available for individual investors who want to invest in private credit, such as funds, exchange-traded funds, ETFs, business development companies, BDCs, or peer-to-peer lending platforms. These options allow individual investors to access private credit with lower minimum investments, lower fees, higher liquidity, and more information than before. Opportunities. Some of the main benefits of investing in private credit are higher returns than traditional fixed income. Private credit typically pays higher interest rates than public debt, reflecting the higher risk and lower liquidity of the underlying assets. According to a report by Prekin, the average net internal rate of return (IRR) for private credit funds was 10.6% as of June 2023, compared to 5.8% for public high-yield bonds and 2.4% for public investment-grade bonds. Lower correlation and volatility than public equities. Private credit also has lower correlation and volatility than public equities, meaning that it does not move in tandem with the stock market and tends to be more stable over time. According to a report by Goldman Sachs Asset Management, the correlation between private credit and public equities was 0.3 as of September 2022, compared to 0.9 between public equities and public high-yield bonds. The volatility of private credit was also lower than that of public equities, at 5.7% versus 15.2%. Protection from inflation and interest rate changes. Private credit can also provide protection from inflation and interest rate changes, which can erode the value of fixed income investments. Private credit loans often have floating interest rates that adjust with market conditions, or fixed interest rates that are higher than inflation expectations. Private credit loans also have shorter durations than public debt, meaning that they are less sensitive to interest rate changes. Ability to customize terms and covenants. Private credit also gives investors the ability to customize terms and covenants to suit their preferences and risk profiles. Private credit loans can have different repayment schedules, security levels, seniority rankings, prepayment options, and other features that can affect the risk-return trade-off. Private credit loans can also have covenants that impose restrictions or requirements on the borrowers, such as maintaining certain financial ratios, limiting dividends or acquisitions, or providing regular financial reports. These covenants can help protect investors from adverse events or actions by the borrowers. Exposure to underserved and growing sectors of the economy. Private credit also gives investors exposure to underserved and growing sectors of the economy, such as SMEs, distressed companies, or niche industries. These sectors often have limited access to public markets or bank financing, but they may have strong growth potential or turnaround prospects. Private credit providers can leverage their expertise and networks to identify and evaluate these opportunities and provide capital and value-added services to these borrowers. Risks. Some of the main challenges and drawbacks of investing in private credit are higher risk of default and loss of principal. Private credit involves lending to private companies or individuals that are not publicly traded or rated by credit agencies. These borrowers may have higher leverage, lower profitability, weaker governance, or more uncertainty than public borrowers. They may also face operational, financial, legal, regulatory, or market risks that could impair their ability to repay their loans. As a result, private credit loans have a higher risk of default and loss of principal than public debt. Lower liquidity and longer lockup periods. Private credit also involves lower liquidity and longer lockup periods than public debt or equity. Private credit loans are not standardized or regulated, and they often involve complex and customized terms and conditions. This makes them difficult to value, trade, or sell in secondary markets. Private credit funds also have longer lockup periods than public funds, meaning that investors cannot withdraw their money until the fund matures or reaches a certain date. This reduces the flexibility and optionality of investors. Higher fees and complexity. Private credit also involves higher fees and complexity than public debt or equity. Private credit providers charge higher management fees and performance fees than public fund managers, reflecting the higher costs and efforts involved in sourcing, underwriting, monitoring, and servicing private loans. Private credit funds also have more complex structures and terms than public funds, such as different share classes, waterfalls, hurdles, clawbacks, or side letters. These features can affect the net returns and alignment of interests between investors and managers. Limited information and due diligence. Private credit also involves limited information and due diligence than public debt or equity. Private borrowers are not required to disclose as much information as public borrowers, such as financial statements, ratings, audits, or regulatory filings. This makes it harder for investors to assess the creditworthiness, performance, or risks of the borrowers. Conclusion. In this video, we have explored the opportunities and risks of private credit investing. We have seen that private credit is a booming asset class that offers attractive returns and diversification, but also comes with significant risks and costs. Private credit is not for everyone, and it requires careful analysis and due diligence before investing. If you are interested in private credit, here are some tips and recommendations for you. Do your homework and research the market, the manager, and the deal. Understand the strategy, the terms, the fees, the covenants, and the risks of each private credit investment. Compare different options and look for track records, transparency, and alignment of interests. Diversify your portfolio across different strategies, sectors, geographies, and vintages. Don't put all your eggs in one basket, and spread your exposure across different types of private credit loans, such as direct lending, mezzanine, distressed or specialty finance. Also diversify across different industries, regions, and time periods to reduce concentration risk. Be prepared for illiquidity, volatility, and potential losses. Don't invest money that you need in the short term, and be ready to lock up your capital for several years. Also, be aware that private credit returns can fluctuate depending on market conditions, borrower performance, or valuation changes. And be prepared to lose some or all of your principal if a borrower defaults or goes bankrupt. Seek professional advice and guidance from experts. Private credit is a complex and evolving asset class that requires specialized knowledge and skills. Don't invest blindly or impulsively, and seek help from qualified advisors or managers who can assist you with your private credit goals. Thank you for watching this video. I hope you found it informative and useful. If you did, please subscribe to our channel, like this video, leave a comment below, and share it with your friends. See you next time.